Yeah, Mr. Sani, you were talking about the era of the 2000 to the 2008 financial crisis. I mean, let's start with that lah. What happened back then, and are we seeing something similar right now? Yeah.
Well, it's back then it was very much a crisis, as we all know. We know it as a dot-com crisis, right? 2000, the Nasdaq started to the bubble started to burst. What a lot of people are probably unaware of is basically that situation ended fairly quickly, in a sense that it quickly moved away from the dot-com. It became a corporate scandal issue. Soon after that, there was Enron, WorldCom. I think even Arthur Anderson had an issue. There were several corporate scandals that surfaced after the so-called the bulk of the dot-com bursting in 2000. Soon after that, we had basically 9/11, the attacks on the World Trade Center. After that, we had basically also SARS. If you remember, SARS was actually back then 2002, if I'm not wrong. And soon after that, we had a consequence of the attack on the World Trade Center, which is the invasion of Afghanistan, and later on even invasion of Iraq. So while it started off as a dot-com crisis, the markets couldn't recover because there was a series of external factors, I would say, because they were not related to the stock market, and therefore it really dragged on for a couple of years. So from the year 2000 to 2003, and ask anybody like me who's old enough, and they'll say that was the last time where we had a really serious recession, a prolonged one. Because thereafter, the only other recession we had was in 2008 and 2009, and that was fairly brief, thanks to the introduction of quantitative easing, and even the 2020 COVID one was very brief. I mean, it wasn't even a recession, so to say. Wasn't felt at all in the financial markets. So, and that's why I worry sometimes. Like Sinji, you yourself and your peers, you come from a generation which has you've not gone through. When you walk into property showrooms, it's empty. When you know when you look at the markets, it's like forever either going down or just not going anywhere. Buying the dips was never a thing to do, because everybody just got their fingers burnt, and markets were just chopping all the way down and such. So it's a situation where I think there's some resemblance now. When I look at what's happening in the markets today. But I would also add that this time around it's unique, because I don't think it's only the year 2000, but I think we're also getting some semblance of 2008. And if you allow me to jump over to 2008, then 2008 was not an external-led implosion crisis, but more of an internal implosion. We all know about the subprime crisis and how the US especially was hit very hard. We had Freddie, Fannie Mac, May. We had Bear Stearns. We had AIG, and a whole bunch of financial institutions spread over to Europe. We had Northern Rock and so on and so forth. So that was basically the financial system coming under stress. So very, very internal, kind of like internal implosion, so to say, and very confined in that sense. And because the financial sector is the bloodline of the world economy, that really hit the world economy quite bad. But still, it was very focus on the financial sector. So I think we're also seeing something like that now. There are elements of certain stresses in the financial system which we think that could implode, and yet we have external stuff like Ukraine, Russia, high oil prices, and so I don't want to scare people, but I'm just saying having experienced both these external-led crisis, internal implosion kind of crisis. And when I look at what we're going through today, it can get quite scary.
Yeah, tying back to what you always mentioned previously, right? You're saying that right now is everything bubble because the 2008 and the 2009 financial crisis, that was in particular just the housing bubble. And when we go back to stretch a bit further back to 2001, that was the a dot-com bubble. Yeah, but things are a bit, although we see a bit of similarities, right? We made a comparison just now. But in particular, let's talk about the inflation rate, right? In 2001 to 2008, during the financial crisis, the collapse of the Lehman Brothers, right? Inflation only stood at what, 5.61%. But right now, can you explain why inflation is just boom over the recent 2 years? It's just like, wow, we've seen worse before, and you kind of explained just now that over the previous from 2000 to 2008, it was just a slow bleed. So I'm thinking that it's probably worse than what we are seeing right now. But when we are talking about prices increase itself, right, it's just it doesn't add up to me. So
we are seeing kind of like a perfect storm for inflation. You open any economic textbook, and you will find that the definition of inflation basically, of course, is higher prices, but there are two sources of it. One is demand pull and cost push. So demand pull inflation is basically when aggregate demand, individuals, companies, the demand coming from this group of people, even governments, pushes the price of goods and services higher because of the higher demand. So it's a demand side phenomena. And there's a cost push side, which is a supply side, which is basically the inability to supply enough goods, therefore causing prices to go up. Because after all, by definition, inflation is too much money chasing after too few goods, and too much money can be, you can always say it's demand behind it. So it's really too much demand and too little supply. Is an imbalance which causes prices to go higher. You can even have just one of it: too much demand, prices will go high; too little supply, prices will go high. You have too much demand coupled with too little supply, and this is what you get today. And this is really the situation we are in, because on one hand, you've had the Federal Reserve and all G7 central banks printing money over the past 10 years like crazy. And so everybody has, as you mentioned, the everything bubble. So all asset prices have gone up. Everybody's felt very wealthy. People on the crypto side were, making tons of money. People were just buying stuff and so on and so forth. So demand was actually far way above what we call the optimal. I mean, I don't tend not to bring in technical terms, but way optimal above the long run, optimal point. On the supply side, we continue to have a disruption in supply. Disruption in supply chain, even chip shortages, and so on and so forth, weather-related stuff. So put them together now, it's basically you have too much money / demand chasing after too few goods. Not only too few goods, but much fewer goods than ought to be the case. Because left alone, we don't even have enough goods compared to what we ought to have because of the supply chain disruption, weather, so on and so forth. So this is where the accumulation of these two factors, to me, has caused the perfect storm with respect to inflation. And that's why we're seeing multi-decades numbers and such, which is, again, when you look at it from this perspective, you understand, okay, it's not always we get both these things coming together. It's not always we get money supply, demand driven so aggressive. Where do you see Federal Reserve printing $4 trillion over a period of 18 to 24 months, stuff like that? Where do you see supply being cut out from the world system, i.e. the Ukraine and Russia are actually very large soft commodity suppliers of wheat, Russian gas or Russian natural gas to Europe, which may not be switched on over the next 10 days because there's this pipeline that's now switched off, and you're taking away again 40% of supply. So these are really very unique situations, and it just happened to come all together. So when you say 9.1, 40-year high, yeah, this is the result of it.
Yeah, it's just the perfect storm of all the catastrophes combining together, and there we have it, the printing of money itself. We are not even talking about the true extent of the printing of money, right, Mr. Sani? Because like in the past 2 years of COVID alone, the Federal Reserve, the asset balance sheet, if I can bring it up later for you guys to see in the audience, they are printing 5 times more money, compared to 10 years ago. They doubled their assets in the span of 2 years, where previously it took them 10 years to do it. And if we zoom out even further, the entire world, or maybe the US, I think maybe it's just tied to the US, has accumulated 2 centuries of debt. We talked about this also, Mr. Sani. 2 centuries of debt in the span of less than 30 months. So, again, we can really see the extent of money printing, but I don't think we can fathom how much really is going on right now. And allow me to just rest on the CPI part, in particular, Consumer Price Index, 9.1%. Is it just only 9.1%? And how do people, are the economists there failing their math or what, Mr. Sani? Because it doesn't feel like 9.1%, And if you look at US, let's talk about US first, then later we'll shift to Malaysia. If you look at US, prices across the board have risen at least 15, 20%, maybe even 30%. You look at the price of meat, you look at the price of real estate, mortgage, everything. But at the end of the day, the CPI numbers come out as, just like 9.1%. So what's going on here, Mr. Sani?
I guess that could be, we always feel that way. I mean, you say that we always feel that the actual inflation is much higher. It could be a technicality because CPI is, after all, a basket of goods that households are supposed to buy every month. Statistics department will do a survey on the same goods. That means they set a particular number of goods that household buys. And this is not only goods that you see in terms of food items. These are also education, insurance, hospital fees, and a whole bunch of stuff. So from that technical perspective, we always feel that, and we're always very close to very sensitive to food prices. So yes, food prices may have gone up, but again, some other stuff may still be lagging a little bit, and those other stuff carry weightage in that basket. So you could also say it's skewed because to us, what's important is food, transport, and stuff, and the two most volatile components, energy and food. Those have gone up a lot. But I think, to me, actually, this 9.1, whether it's 9.1 or 10.1, whatever the case is, actually the more scary part of it is if it doesn't come down. Okay, so let me explain a little bit. So this 9.1% tells you on a year-on-year basis, prices have gone up by 9.1%. Okay, I can't recall what the actual month-on-month basis is, but quite safe to say, I think it was 1%. So quite safe to say, over the past couple of months, at least we've seen prices go up across the board by every month by 1%.
Yeah. It's about one to about 1 point.
Yeah. Okay. So let's just take, for example, and I've mentioned this example before, oil prices. Okay, let's focus on one single item, but this can be applied to every single item. So oil price has increased from, let's say, 70 to 100. Okay, that's roughly about a 50% increase. On a year-on-year basis, you will get those really large numbers because you're comparing to a very low base and such. Now oil prices settle at 100. Let's assume, okay, and oil prices remain at 100 for the next 1 year. When next year, this month, which is July 2023, if you do a year-on-year calculation, or for your oil price, so-called price index, or your CPI, which is purely just on oil, you're going to get zero growth year-on-year. Because oil at 100 today, oil at 100 a year later, that's zero growth year on year. But guess what? Oil is at 100. Economies, households cannot deal with oil at 100 if it remains there. So you may get a recall. The actual year-on-year statistical data showing a decrease in CPI is not longer 9.1; it's up 4% year-on-year. Everybody goes, yeah.
This is mentioned. What you just mentioned there, right? I think a lot of people don't understand, because, like, say, we put it to a more relatable state lah, for normal folk. The cost of kopi O, let's say right now, at RM2.50, right? And we are talking about, let's say we stick to the figure, we round it up, 10% inflation year over year, which means that kopi O used to cost 10% less a year ago. But kopi O, if it stays at the same price from this year to next year at RM2.50, essentially 0% inflation, but it has already inflated 10%. That's
your disposable income is down basically, and it doesn't change.
It's not deflating. It's not going back to its previous price.
So unless you see deflation, so unless you see year-on-year figures coming in at -2%, -4%, -6%,
and is that possible? Is that possible to have a negative inflation?
Of course. So it's possible. So we're potentially going to see what economists call disinflation, and disinflation is basically inflation coming down from 9 to 6 to 5 to 4. Whether we get deflation is another story. Won't rule it out. If we do get a very deep recession, these things happen. But at this point, when I look over on the supply side, oil prices have come off, for example. And when I start to look into the tweets by people who I consider to be expert in the oil market, all of them are saying, hey, look, oil prices, when we talk to the refiners, when we talk to the people on the ground, actually demand is still very strong. And when you look at what the data OPEC is releasing, OPEC Plus is releasing, they're all struggling to produce, to meet their quota, because they've failed to put in capex over the past 10 years to drill more oil. So it's preventing them from producing more oil. So everything suggests to you that it's going to be very difficult for oil prices to collapse. So what we're seeing now from the oil price 100 over, and then people are selling it off now, it's 90 and such, and then they're saying, oh, it's because people are now factoring a recession, it's going to come off. The actual data itself shows that these are CTA, commodity trading accounts, hedge funds and such, just going, covering either their longs or going short in anticipation of a recession, which is totally different from what the people on the ground see from the physical side of it. So that's what I'm gathering from this. So that gives me kind of like a sense that, I think prices will remain high. Disinflation, maybe. Deflation, unlikely, unless we see a very, very sharp recession.
Yeah, I mean, when we talk about a part of deflation, right, it's really unlikely because the money printing never stops. Right? Every year, we continuously print more money. Therefore, the money supply is ever increasing by a minimum of 2% per year. But we all know it's much higher than 2% per year. They just say it's growing by 2% per year. But you look at inflation figures right now. And I think another thing that people don't really understand is that, let's take a look at the goods that are cheap, in this case, let's say bread, those common goods, and rice and so on and some sort. The price of bread, let's say, if today it's priced at RM2.50, and the next day it increased by 50 cents. Now, to common folk, they'll just say, oh, it's just a 50-cent increase, it's not much. But if we do the math, that in itself for bread is a 16% inflation already, which it goes very understated lah. I'm not sure whether you will agree with me on this, Sani, because a lot of people, there are still some people thinking that they're still trusting the politicians and believing that inflation is much lower and it's not a problem. I'm going to believe the CPI numbers, but in truth, it's actually much more darker than what has been portrayed.
It's whether I mean, I totally agree. I do think prices will remain where they are. So, like I mentioned earlier, even though the year-on-year numbers may start to taper off and people pointing to it say, hey, no, inflation is no longer an issue, but the fact that your nominal price levels remain elevated or remain very high means you have less to spend elsewhere. I'm very concerned. Okay, I'm very concerned for the second half of the year. I mean, if we can switch a little bit to the more macro side of it, if you give me, if I can talk about the macro side, the first half of the year, and this is what I tell all my clients basically. I say in the first half of the year, what we saw basically was we saw two types of shocks. One was the interest rate shock. We've not seen interest rate rise so fast in such a very short period of time. So things like bonds were hit tremendously because bond markets are very sensitive to a rise in interest rate. We all know increase in interest rate, bond prices come down. And the second one was we saw a valuation shock. Valuation shock because for the past couple of years things have just gone through the roof. Valuations have gone far beyond fundamentals, and all of a sudden the handbrake was applied and everything just came tumbling down, like crypto or tech stocks and stuff like that. Okay, so we saw a valuation come interest rate shock in the first half of the year. Right now, those shocks are softening, abating, meaning to say, when I look at forward-looking indicators, inflation seems to be peaking. Valuation also, bond prices have come off, stock prices have come off. So, hey, good time to buy because those shocks have been priced in. And now that's why we're seeing markets stabilize a bit. Yesterday, 9.1 inflation, initial sell-off, and lo and behold, within an hour, everything went back to where it was before the 9.1% shock. That tells me that the market is now underpinning the market is kind of like a bullish sentiment now, because people are saying, inflation coming off, prices of assets have come off, Fed's going to reduce rates. What's there not to like? Time to buy in the market. But we forget that basically once you start raising rates so aggressively in the first half, once the asset prices come down so much, resulting in what we call destruction in wealth, what you get basically, you get a very sharp slowdown in the second half of the year, or at least 2-3 quarters ahead. And we're also seeing that in the numbers now. It's just that those risks are not very at the forefront at this point. Okay, so we are really and I'm giving a talk to our clients next week or after that. The title of the talk is we are in the eye of the storm, in the eye of the hurricane. And I know hurricanes are not very common in Malaysia, but if you've seen the movies like Storm Chaser and stuff like that, I can't remember the name. Hurricanes, basically, when they pass through a town or pass through your home or whatever the case is, it just hits you at like 100, 200 miles per hour kind of winds, and all of a sudden it just becomes very calm because you're in the middle of the eye of the hurricane, in the middle part where the swirling, right in the middle, tengah-tengah tu, it's actually a very calm one. And then after that you get whacked because the back part of the hurricane comes and hits you, because it's again you're moving out from the center of the hurricane all the way to the side of the hurricane. So we are in the center now, where things look very calm because the risks from the first half look to be coming off, and we've not seen the risks from the second half coming into the forefront into the main headlines yet. And so what are the risks in the second half? The risk is, as the economy slows very sharply, you are going to get two types of shock. Shock number one is you're going to get a credit shock. Why a credit shock? You brought it up earlier. The world has 300 trillion worth of debt. Interest rates are 3 or 4 times higher than they were 6 months or a year ago. Out of the 300 trillion worth of debt, I read somewhere that 60 trillion needs to be rolled over every single year. So on average, the debt is about a 5-year maturity. So it's about 60 trillion. There will be a huge bunch of companies who will find it extremely difficult to roll over the debt, especially those low-grade companies. They used to borrow. These are zombie companies. Used to borrow at 1% or even less than that. People were willing to buy bonds at negative interest rates at one point. And so when they go to market to try and roll over, used to be 0.5% debt, now is trading at 3%. It's not enough. People will not lend money to a zombie company even at 3. it's going to be 6, 7, 8. I mean, look at what happened to the Chinese developers and such. Now they are rolling over at double digits. So there's going to be a lot of defaults. Anybody sitting in the below the investment grade category, especially if you are in the triple C's, single B's and such, we think that default rates will actually go up. And the second thing is the liquidity shock, because we've been living in a world where liquidity has been extreme, and that liquidity is being siphoned out because the Federal Reserve is undertaking quantitative tightening. We are in a risk-adverse environment where people are less willing to lend, and there are specific pockets of the financial system which may be more vulnerable. Give you an example: emerging market companies who have, over the past couple of years, opted to issue dollar-denominated debt. That means issue bonds, but in US dollars. Okay, because of that, right now they find themselves having to pay coupons or even a full repayment of those debt in US dollars. And guess what? The US dollar is just so expensive now compared to your local currency. So if you're an emerging market corporation earning revenue from local, in terms of local currency, and having to pay your debts in US dollars, you're screwed basically. And the fact that there's going to be there's already a shortfall in US dollar liquidity in certain places already. We're starting to feel it already. I just saw on Twitter that I think earlier today, certain places there's a shortage. Won't be surprised. We saw that same shortage in March, April, May of 2020, where the Federal Reserve had to step in and give what we call swap lines to Bank of Indonesia and the MAS in Singapore and such, in order to make sure that around the region, corporations still receive what we call US dollar supply. I think that shortage is also going to happen. So what we're going to see, I think we're going to move away from one set of shocks that we saw in the first half of the year. We're going to move into a new environment where we're going to see a different set of shocks happening. So that's what I'm actually prepared for.
Those are really a lot of points you covered right there, and I just want to really quickly unpack what you just said. Really, thank you for those thoughts, by the way, Mr. Sani. First, you started out with the debt crisis, right? Because you have some companies, zombie companies, owing tons of money, and now interest rates are higher already. Essentially, the cost of debt is much higher, and we are seeing the similar things happen in crypto right now, right? If you take a look at the collapse of Three Arrows Capital, Terra Luna. It all started with Terra Luna first, then Three Arrows Capital. All these companies which are, they weren't paying attention to their debts. They took out too many loans. They went full degen and stuff. We are already seeing it in the Web3 industry, and now it will probably shift on over to the TradFi, traditional finance side. And the other thing you mentioned is also about the strength of the dollar itself, right? Because the dollar strength right now is crazy. For those of you who are earning US dollars, yay for you. But imagine Sri Lanka right now, how much debt they are in, and for them to repay that debt in US dollars is just crazy. And that's one of the biggest reasons why Sri Lanka went bankrupt also, which we will discuss with you later, Mr. Sani. And it's a scary sight, Mr. Sani, to say the least, that what we are seeing right now. And although you've been through something like this, you have a lot of experience in terms of crises, but is it fair to say that what we are seeing right now is way worse than probably what you have experienced in your time?
What I would say is it has the potential to be way worse. Yeah. So, and the reason being is anytime you have what we call a dislocation, misallocation of resources, which we have seen over the past 10 years, all this money being pumped into the system, making its way into all the asset classes. Typically, you would see basically, there's a bubble in the stock market. There's a bubble in the tech sector. There's a bubble in the bond market. There's a bubble in the property sector. It's never there's a bubble in A, B, C, D, E, F, G. Every single thing is a bubble, like you mentioned. It's everything bubble, and that's really the consequence of massive injection of liquidity. So, so that in itself is a big risk. because we've never seen multiple bubbles deflate all at the same time. And I'm not saying it will happen. I'm just saying at this particular point, those are clear and present dangers as we go into a slowing economy. Okay.
Yeah.
So that's really something which is scary. At the same time, you have central banks which really have not much maneuverability. Unlike the past 10 years, whenever there is a decline in the asset market, the central banks basically were worried about deflationary impact, because they looked at what happened to Japan and so on and so forth, and there was this inability to spark inflation because of, again, in technical terms or econ terms, what we call money velocity was very low and so on and so on. So central banks were more worried about deflationary impact. So that's why they pump. They pumped everything. Right now, and they were able to do quantitative easing. They were able to bring down rates because inflation was not the problem, deflation was the problem. Right now, if the market falls another 20%, how is the Federal Reserve going to come in and support the markets? Impossible, because its mandate is, I need to combat inflation. It's right now, if I look and try and support the stock market by reducing interest rates, by doing quantitative easing, that goes contrary to my mandate, which is actually to fight inflation, to make sure that what we call the real interest rates is back into at least zero or at least positive. Right now it's one of the biggest negative real interest rates that we've seen in history, which is ruining the Federal Reserve's reputation.
Yeah, again, good point right there. You talked about the Federal Reserve's goals is to maintain price stability and maximum employment, right? So I think this is what a lot of people misunderstand also, because some of the people still think that, hey, actually the Federal Reserve, look at the stock market drop, at the end of the day, they will come in and save the stock market. But in this current situation, I don't think that's going to happen. And I think, Mr. Sani, you can agree with me also, because inflation is red hot right now. And again, just echoing back to what you said, it goes against their policy to suddenly inject liquidity back into the market or reduce interest rates in this very extremely inflationary environment.
Yeah, they can't. Their hands are tied, basically.
Their hands are tied, and I would say they're boxed in right now. And the only thing they're left to do right now is to aggressively raise rates. Like we've seen it, right? Previously in March, the first time when they raised rates, it's like 0.25%. They wanted to ease it in, but then they realized that we can't do it. We have to be more aggressive.
Yeah.
They doubled the rate hikes from 0.25 to 0.5%.
Yeah. And that's if you look at the ECB, they've tried to do it a little bit more different than the Federal Reserve, because the ECB itself, despite the fact that inflation had moved up sharply, they were very worried because they were having problems with what we call the peripheral countries. Italy was having issues and such, and more so because of the war in Ukraine and the energy blockade and still Russian dependence on Russian energy and such. So at the back of the ECB mind was basically that we are headed for a recession. So theoretically I can't raise rates, or I can't be so aggressive like the Federal Reserve, despite the fact that interest rates are high. You pay a price for that, because you don't raise interest rates, you suffer from what we call real negative interest rates. And you just have to look at the euro. What happened to the euro? It just hit parity with the US dollar.
It already depegged. It's now
depegged. I like that word.
0.995.
Yeah. So something has to give way. If you want to adopt you want to give priority to certain things, something else has to give way. So different central banks will focus on different aspects. The BOJ, the MOF in Japan, they've decided to do yield curve control to make sure that basically yields remain low in Japan. As a result, same thing. Your interest rate differential with the US is super wide, and it's reflected in the currency as in terms of your yen weakness. So yen has also gone down the drain with respect to the. So it's all tied together. You want to keep rates low, you have to accept that your currency is going to be battered. You want to raise rates, you have to accept that your economy is going to be battered. So it's that kind of of place we're in, where there's a cost to everything you do.
Yeah, there's a push and pull, and then there's a cause and then back to everything you do. I guess again, just recapping to what you just said right there, a lot of points covered, is that talk a bit about the interest rate differential, because I think the audience here may not understand what we are covering right now. So in particular, when it comes to we have the Federal Reserve, we're talking about a few entities here, guys. So we have the Federal Reserve, we have the ECB, which Mr. Sani mentioned just now. ECB stands for European Central Bank. So basically, it's like the quote-unquote Federal Reserve of the European Union side also, okay? And you have the BOJ, the Bank of Japan. All these entities are competing with each other when it comes to interest rates. So you have the Federal Reserve raising interest rates first, and that usually increases the strength of the dollar itself. And then if these other entities, they are slower and they don't raise rates as quickly or on par with the United States or the Federal Reserve, then their currency will fall. So right now you're seeing why euro is so weak is because they're not raising interest rates as quickly as the United States or the Federal Reserve is doing. So did I roughly cover what you're trying to say right there, Mr. Sani?
Yeah. Currencies are always a function of what we call the balance of payment.
Yes.
And the balance of payment is made up of both the current account and capital account. And interest rate differentials basically result in, if you have a higher interest rate, I'm going to park my money with you.
Yeah.
So the demand for that particular currency with the higher interest rate is going to be very high. So stronger currency.
I guess.
Course, I
guess we can also push it back to the Malaysian ringgit, right? Because if you take a look at the Malaysian ringgit, why is it weaker right now? Is it because yes, at least you have some people talking about Malaysian ringgit go up to 4.4, it will come back down again. It won't go past its March 2020 high. You know what I mean?
Yeah.
But
it's an interesting thing. Yeah. Sorry.
Yeah. Go ahead, Sani, please.
Sorry, because you were breaking, so I didn't know whether you stopped. Okay.
I broke away.
Yeah. No worries. Yeah, I think everybody in the room probably need to understand, if you haven't understood it yet, that currencies are basically a function of a pair of currencies. It's always US dollar against ringgit, Sing against ringgit, and so on and so forth. So when you see the currency pair moving in a certain direction, let's say dollar ringgit moving from $4.0 to 4.20, it impresses on you that the ringgit has weakened, because for every $1 now you can command $4 ringgit 20 cents, correct? Because previously it was 4. But you must remember, you must always ask the question, was it because of dollar strength or was it because of ringgit weakness? Because either one of those two things or a combination of those two things could have caused your ringgit to move from 4.0 to 4.2. Okay, it looks to be at this particular point, a big chunk of that movement from 4.0 to, let's say, 4.2, 4.3 is due to dollar strength, because dollar interest rate differential is just so much larger than every other currency. So you will see the dollar strengthening not only against the ringgit, but also against the Sing dollar, the rupiah, the euro, and so on and so forth. Okay, so underlying it is dollar strength. If you want to see whether the ringgit itself is strong, you then pair the ringgit against your regional currencies, for example. Has ringgit baht gone up or down? Has ringgit peso gone up or down? Has ringgit rupiah gone up or down? Has ringgit Sing gone up or gone down? So from that gives you a reflection. Both, let's say for example, both rupiah and ringgit have both weakened against the dollar. Fine. Dollar ringgit is up, dollar rupiah is up. But when you pair ringgit and rupiah, it then gives you an idea who has weakened less against the dollar. Then you can say ringgit actually has strengthened against the rupiah, or ringgit has weakened against the rupiah. So that gives you a little bit of better idea whether the ringgit in itself is on a stronger or weaker footing.
Yeah. Again, thanks, Mr. Sani, for really, providing such a detailed explanation on these currency fluctuations. And just to track back to what you said, and I quickly just Google searched Malaysian ringgit to Thai baht when you talked about it. Actually, Malaysian ringgit is strengthening against the Thai baht.
Okay, yeah, so it could be a case. That's what I'm saying.
Yeah, so
it's weak against the dollar, but strong against the baht.
We're all veering towards a strong US dollar right now, and goes back to the main point of interest rate differential, right? Because the Federal Reserve has been raising interest rates. I think up to today is 150 basis points already. If we add up the next FOMC meetings, probably add up to 150 basis points already, which is about 1.5% rate hike already. But meanwhile, Bank Negara is still, I think last month only they raised 0.25%, or am I wrong?
Yeah. What's interesting is I think the euro dollar futures market is already incorporating a terminal rate which is much earlier than what we initially expected. Previously, we thought that the Federal Reserve would actually pivot at about 4 to maybe 4.5% first quarter, maybe second quarter next year. The market is now telling us they could actually pivot in the first quarter of next year and even in the final quarter of this year, and pivot basically at about 3.5% maybe. Why is that? It's basically because the market believes that the economy is slowing at a much faster rate than the Federal Reserve, or rather at a much faster rate. So it will force the hand of the Federal Reserve to reverse whatever is done much sooner and much more than initially thought. So that'll be interesting, because when that happens, by right, and again, inflation, monetary policy in different countries are at a different part of the curve. We could have a situation where Federal Reserve US rates are coming off. Let's say Malaysian rates are still probably, let's say, going higher. Okay, but that doesn't also automatically mean that dollar ringgit will come off, i.e. ringgit will strengthen. It really depends again. If we are in a situation where the whole world is slowing, and I believe there's this underlying evidence that some of the demand for dollars is actually due to safe haven. There are just very few safe havens nowadays. You want a safe haven, there's not many places. It used to be yen was a safe haven. It's got decimated. Treasuries were safe haven. I think that was, it's down because of what happened with higher rates and such. Dollar is a haven, and it's showing to be the case. Gold was presumably a haven, but it's not gone anywhere, and in fact lost a little bit. So I think we are in a world where havens are there's a lack of havens, safe havens, and even though interest rate differentials may narrow against the dollar, there could still be demand. Like I mentioned also earlier, second half of the year, if there's a shortage of dollar, it will be irregardless of where interest rate differentials are. If I'm a corporation, emerging market corporation, and I need dollars to pay my coupons on my dollar-denominated bonds, I'm going to secure it regardless. Yeah, so there could be other factors. I just wanted to bring it up to tell your listeners that while interest rate differentials are important, sometimes it's you can override it with other stuff.
Yeah, essentially we are driving the point back to supply and demand also, right? And other factors, like what you just mentioned just now. Yeah. But it's really interesting on what you talked about, in particular the Fed pivot. For those in the audience, if you don't know what a Fed pivot means, it is literally as simple as what it means. It means that the Federal Reserve just turned their tail and they're now doing a completely opposite policy. So let's say if they were aggressively hiking rates, then if they pivot, then suddenly they go back to lowering rates or something like that. It's just like a sudden U-turn now, something like that. Am I right about that, Mr. Sani? Did I?
It's pivot means just U-turning on its current path.
So just for the audience to really understand what we are trying to say. But we have the
Haikal, right?
Haikal over here. I think Haikal had a question just now. Yeah, Haikal, please go ahead.
Not
Hello?
question, just to add on the performance basically, because I deal with BOP. I work at the Foreign Exchange Policy Department at Bank Negara, so I may add a bit on this So basically, it is as Mr. Sani said it's actually dollar strengthening against everybody. And as you mentioned earlier pun, memang if we actually look at other regional currencies, Malaysia is doing comparatively well against other currencies. It's just that we are weakening so badly against the ringgit, against the dollar, because the dollar is strengthening. So on that part, Mr. Sani is right lah. And another part that I wish to add on about why we are seeing first thing first is flight to safe haven. And the second thing is we are actually seeing these are public data. There's no secret. This is no confidential data. You can just access it at MSB, monthly statistical bulletin at Bank Negara. So nothing, no suspicion, no hanky-panky stuff here. What we are seeing is that large Malaysian corporates, they are actually keep building up their FX reserves. So they are depositing more in dollars. So that also contributes to ringgit weakening lah, because they are demanding more dollars. So those are some of the things I wanted to add on. And maybe when you go to Sri Lanka or other stuff, I might want to ask a few questions lah, which I think is good that we have this session, because it's good to hear from an outsider as well. Thanks.
Thank you, Haika. It's always very good to have a central banker or someone working in the central bank
those are actually very
contribute. Yeah. But the data that you just mentioned is exactly what I meant. What I said. Corporations, having gone through March 2020, where everybody was all of a sudden shocked to realize that it's dollars are just not freely available 24/7. Had to scramble to find it. So now they've learned their lesson, and that's why a lot of companies who are net borrowers via US dollar denominated bonds, they are now building up those reserves. So great information, Haikal. Thank you very much.
Yeah. Again, thank you so much, Haikal. You're more than welcome to stay on the panel if you want to. At the end of the day, this is an open discussion. Okay, so for anybody in the audience, if you want to ask Mr. Sani any questions or you have any comment to make, do not hesitate, because the session tonight is really open for everyone. We want to make sure that you get your questions answered, or if you have something else to add, just request to be a speaker. You'll immediately be approved. Yeah. Okay. Let us shift gears now. Okay, we've talked about inflation just now. Why is it so sky high? But I just do want to end this current topic at a quick question. Safe haven asset right now, let's say gold previously was a safe haven asset. Bitcoin was thought of as an asset, and it turns out that we were blatantly wrong. So Mr. Sani, right now, US dollar safe haven asset, how long will this last? Because at the end of the day, we talked about this, cash is king right now, right? And a lot of people are flocking towards the US dollar because the Russia-Ukraine war, and now we have Sri Lanka here and there, and people are stacking up their dollars like crazy right now to quote-unquote repay their loans. So will this stretch out all the way until next year? Do we see it going further? Or will the safe haven asset change? Maybe back to gold or Bitcoin or something like that?
If rates stabilize, then of course I think, because right now one of the problems we have, even as my in the current position as an asset allocator, is portfolio theory tells you that always allocate to equity and bonds, because when equities are up, bonds are down. When equities are down, bonds are up. So your portfolio net should be doing okay, because there's negative correlation between the two. What we saw in the first 6 months was we saw positive correlation between the two. Equities were down like 20%, bonds were down like 13%. There was nowhere to hide. If that correlation is broken and we go back to what we call normal negative correlation, I think people will start looking at treasuries and they already chatter about that. Some people I know are reallocating back, saying that it's maybe time now to start looking at the re-establishment of this negative correlation. So it's safe to tiptoe back into the bond market, but very selectively, high quality government bonds and stuff like that. As we get more clarity on the interest rate side, inflation is coming off, monetary policy may be pivoting, so it's fairly safe to tiptoe back. So we could see treasuries come back as the safe haven play that it ought to be for many years. But the dollar still is underpinned by not only that safe haven, but by the demand we mentioned from the corporates itself. So I think that's very strong in my view. So it's going to be hard to see the dollar coming off in a very severe economic downturn where people are worried about what's going to happen elsewhere. and the demand, the natural demand from dollar-denominated debt holders. Yeah.
Right. Okay. Thank you again, Mr. Sani, for your points over there. I just want to quickly summarize what you just talked about, and I think we both can agree that the dollar's strength will kind of remain, and last throughout probably this year or probably next year. And we don't expect the collapse of the dollar anytime soon or stuff like that, because there are still people talking about like US dollar will collapse, the world will end, etc., etc. But
I mean that's a long-term thesis.
Yeah,
So it will play out.
It will, yes.
I believe it will play out the way it's going, but it's a slow motion kind of thing. So
it will take tens of years. It will take decades, right? It will take decades for the US dollar to gradually collapse. Actually, we are seeing the collapse of the US dollar right now. There are symptoms of it already. You are seeing like Russia no longer accepting US dollar for oil. You are seeing like China starting to use renminbi and stuff like that. So that's I would say is the starting symptoms, but we will have enough time to react to it at the end of the day, right? So let's lay this at rest and we'll shift gears a bit because we still got one more big topic to cover. Sri Lanka. Let's talk about it, Mr. Sani. For those in the audience, I've written a thread about Sri Lanka. You can basically just read the thread right now very quickly. But let me just summarize to you in the audience on what happened to Sri Lanka, okay? So basically, the country is in shambles right now. I would say the country has collapsed already. And this collapse was entirely man-made. It's not due to nature factors or COVID or something like that, but rather it was due to years of bad planning. I wouldn't say years, I would just say it collapsed so quickly, in less than 2 years, the country collapsed. And you can really see the effect of centralized planning over here and government policies when they literally have not much education on the economy. They start doing a lot of bad calls after another, and the entire country goes down the drain. So quick updates right here. The president of Sri Lanka has fled to, I think, the Maldives. The rich, right? Talking about the rich again, they always have an escape way out. While some of the citizens at Sri Lanka, last I heard, was queuing about 5-6 days for fuel, and the entire country has run out of fuel already. So it's a very bad sight right there, right now. So, Mr. Sani, what happened, man? Why did Sri Lanka come into this crisis? And at the end of the day, what can we learn from this?
I've learned a lot from your thread.
No lah.
It was a good thread. I think I would recommend everybody go and read the thread where you've probably highlighted most of it, the reasons behind it. It was a lot to do with mismanagement, people who were probably incompetent to run the country from an economic standpoint. I mean, they tried to move into so-called organic, non-fertilizer. It backfired. You were saying that. I read about that. I think there was a little bit of not little bit, but there was a widespread cronyism in the political side where relatives were being appointed, and so it was really a whole bunch of stuff. And I think prior to this also they lost a pot to China because they couldn't repay back some debt and so on and so forth. So what I really, and let's bring it back to Malaysia since we're here.
Let's bring it to Malaysia. I think that
I don't think it can happen in Malaysia, meaning to say that Sri Lanka was already kind of like, in terms of its credit worthiness and such. If you look at its credit rating, it was already probably non-investment grade and such. But that's not to say that Malaysia can't drop a few notches from where it is today. Haikal, if you remember, I think it's still A- if I'm not wrong. But a few notches would bring it down to maybe triple B minus, just above investment grade or whatever. So Malaysia really has to be very careful with respect to its fiscal position. You just remember last year, 2 years ago, I can still remember the headlines. Malaysia was going to buy vaccines, and basically the government said we can't afford the vaccines. We need to dip into something called the National Trust Fund. if I'm not wrong, in Malay, it's called KWAN, Kumpulan Wang Amanah Negara, or something like that, which tells you that basically Malaysia has reached a point where it's a bit like the US, where it's hitting against the debt ceiling and so on and so forth. And I worry about it because I'm Malaysian also, and I worry, and I've also tweeted about this. I said, look, given the situation that's going on now, I personally feel we're headed towards slower economic growth, potentially even a crisis. We should be actually moving into a DEFCON 5 emergency ICU, not emergency ICU, but emergency mode, where we start doing things to try and beef up the finances of the country. We keep on talking about how Malaysia is benefiting from higher oil prices and such, but at the same time, let's not forget, it's one of the highest subsidies in the world with respect to oil. So whatever Malaysia brings in, I can't remember the numbers itself, but I remember it's fairly large. Whatever Malaysia brings in terms of revenue, oil revenue, for every dollar that it's above its anticipated budget, it's all being used up for subsidies. So we've and if you look at the and again, Haikal and those of you who are in the know, I can't remember the exact number, but I believe our reserves, or rather our stabilization fund, because the KWAN is supposed to be a stabilization fund, it's a very small amount. Compared to Norway, it's just a drop in the bucket. I mean, Norway itself 20-30 years ago started a stabilization fund. I can't remember again the actual amount that they put in, but I think a certain amount of oil revenue went into that stabilization fund. That stabilization fund now is I think many more times larger than that of Malaysia. Singapore itself has a rule where gains made from GIC, I think, even from Temasek, I think, it's all kept. Half of it can be used for the budget, and half of it will be kept in reserves. And these reserves cannot be touched unless there's parliamentary and a presidential approval, and released during times of need. And that was during, I think, the crisis and such. So what I'm trying to say is many countries set up these kind of stabilization funds in order to either use it during times of duress, under stress, or eventually, like in the case of Singapore, and also in the case of Norway, eventually to replace some of the revenue that budget, or at least to supplement the revenue in the budgets. So Norway knows, for example, that eventually oil can't last. But now, as oil declines, for example, the gains that they make, the investment returns that they make, now replace the loss in oil revenue. So what I'm trying to also say is we need to do something. If you're talking about a 2022 budget, I can't recall last year, I think it was $65 and such. We really need to now say, hey, whenever we set an assumption in the Malaysian budget, let's set it at a conservative level in terms of oil price. Anything above that, let's keep it in this reserve stabilization fund, rather than we say let's spend every single cent that we get. Because the last time oil prices were above 100, I think, if I'm not wrong, we didn't manage to save anything. It's like everything just went out. We managed to supplement our revenue. Oil prices were above the assumptions, and so on, which then doesn't leave a lot for the future, which then doesn't leave us with an emergency fund. Yeah. So I'm concerned, and I think I've read somewhere that there are some fiscal responsibility measures going to be taken in the next budget. I hope to see something along this line. We have to start somewhere. We have to start building up this reserve, because eventually when the oil runs out, eventually when palm oil prices collapse, or whatever the case is, at least this fund, which is generating a reasonable return, those returns can be used to supplement the budget. I mean, that's a diversification of your revenue stream. So that's one thing which I thought it needs to be done sooner rather than later. Yeah.
Allow me to just unpack what you just said. You covered a lot of stuff right there. Yeah, and essentially, I think your point being is the foreign reserves, right? Yeah, like your savings. Essentially, if you relate it to person, it's just kind of like a family. Just think of the country's economy like a family. And right now, Malaysia is spending without saving. Yeah, every time a paycheck comes in, they just spend their entire paycheck, right? To keep things simple, and they're not saving money. And in this case, the money that we're talking about is the foreign reserves now, because every single country has their own foreign reserves, and foreign reserves is extremely crucial to a country. This is the primary reason why Sri Lanka collapsed, is because they no longer have any savings to sustain them, and they cannot take any more loans. So essentially, the country is bankrupt. So just allow me to touch very quickly on foreign reserves, because they are used to pay off debts and maintain competitively priced exports. And to date, most of the world's reserves are held in US dollars. So which goes back to our big arcing point, which we mentioned about on the US dollar strength right here, the flight to safe haven assets, blah, 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 is also talking about the foreign reserves. And what Mr. Sani covered just now is that Malaysia doesn't have enough foreign reserves, right, Mr. Sani? And
it's also I mean, you're right to say there's a foreign reserve element to it, and the word foreign there tells you those reserves relate to the balance of payment. But there's also the reserves which are basically true reserves, meaning to say, just give you an example, like I mentioned, stabilization funds. Those are reserves, and they can be held in foreign currency, whatever the case is. But those are reserves built up for a very specific purpose. As the name implies, stabilization is to stabilize your budget when there are periods of time where you're facing stress on your budget. And like you correctly mentioned, it's like an emergency fund. Family suddenly, breadwinner loses his job. Income suddenly declines because only the wife earns money, the husband lost his job. You can dip into that emergency fund to supplement and make sure that no one suffers, there's food on the table and such. Because without that, you will be cutting left, right, and center your expenditure in you see, in normal economics, in normal economics, it's C plus I plus G, consumption plus investment plus government. That keeps your economy going and net export. In a recession, this time around, I'm going to tell you, your consumption and your investment will collapse. The only person who will be able to come in to support the economy will be the G, which is the government. Richard Koo from Nomura is very famous with this. It's happened in Japan. It's called the balance sheet recession. It's really the experience of the Japanese where the C&I, consumption and investment, collapsed. And the Japanese government didn't realize, and they kept doing austerity, and that's why the Japanese economy was in the doldrums for many years. And only then they started to realize, no, we have to step in and we have to do, whether it's, you want to call it Keynesian economics, where fiscal is the key thing and such, but you need money to do that, because without money, you're going to rake up your debts, your ratings are going to drop 2 or 3 notches, and then you're going to have a new set of problems. So it's very important for the country to build that reserve, starts sooner rather than later. Otherwise, there's going to be a lot of problems.
Exactly. Like you mentioned right there, the major reason why Sri Lanka collapsed is because it no longer have any rainy day funds. To put you guys into context, foreign reserves in Sri Lanka, 50 billion in 2019, okay, fell to 50 million right now. Can you imagine, in a span of like 2 years, 50 billion got drained out, pay off all their stuff in the current economy. Right now, they have 50 million left. They are unable to repay their debt, so on and so forth. And in the international world, when we talk about country to country, whenever you're unable to repay your debt, since there's no international courts to turn to, nobody can sue you, but the credit rating agencies will downgrade your country. And it will prevent you from taking loans in the future, which is like a death spiral. Essentially, once you collapse, you are no longer able to take loans to keep yourself afloat again. But the only solution is to take loans to keep yourself afloat. So do you see the dilemma right here? Which is why Sri Lanka right now is looking for a last line of support, right? They looked at the World Bank, recently loaned them, I think, 600 million. They're also looking at the IMF, right? They're also looking at China to loan them funds. But it's looking grim, you know, at the end of the day, Mr. Sani. And it goes back to our point of building up the reserves, right? Which is really important for a country. And
I've just sent you something on the WhatsApp. I don't know if you can post it on the chat on top there.
Okay, let me take a look at it. Yeah. Meanwhile, you can just you go ahead. You go ahead.
Yeah, it's just a table from the Edge. I think the Edge had one article on Kwan. I think 2 years ago or last year when the vaccines, part of the money from Kwan was used to buy the vaccines, about RM 5 billion if I'm not wrong. And there was this huge debate about should it be used, shouldn't it be used. I mean, my own view is yes, it's you're supposed to use it in times where you have a need to. So I'm all for it. The only problem is it's very minute. It's very small because I'm not familiar with the mechanics behind it. Is there compulsory injections? But I know Petronas does injections to it. I'm not sure whether there's an act which says that how much of every year the revenue from oil has to go into it, because if it's really the case, it ought to be much bigger than what it is today. Because I can read here it's only about 5 billion US dollars compared to the Norway's pension fund, which is like 1.1 trillion US dollars, and even Timor-Leste, which is, as you all know, Timor-Leste, it's a new country. Its petroleum fund is even bigger than our Kwan petroleum fund, because its petroleum fund is 17.7 billion. So again, I'm just trying to give some constructive feedback to say, you know, we really need to do something to build this up.
Yeah. About the picture you sent to me just now, right? I think Mr. Sani, it's very good if you can write a short thread about it. Then after the session, I'll be able to just retweet and keep the ball rolling from there. Yeah. But we covered on inflation so far. We talked about the crisis in Sri Lanka also, and ultimately what can the Malaysian government learn is that they have to build up their rainy day funds. Now they have to build up their foreign reserves one way or another, or the stabilization fund which you just mentioned. Otherwise, during a crisis like that, or maybe something similar, Malaysia won't have any outs to run away, and we will see something like a death spiral, and the entire country collapses just very quickly in the span of 2 years. And Sri Lanka was known to be actually one of the more successful countries in the Southeast Asia. Actually, is it Southeast Asia? I'm not so sure, but
South Asia, yeah.
South
Asia.
Yeah. Correct me. Sorry, not so good on geography.
No worries.
It was one of the most successful countries. Its tourism industry was booming. It was very successful. Then came COVID, blah blah blah, and plethora of different screw ups from the government, which entirely collapsed the economy. Which is why you see massive protests in the street right now. Yeah, I think we will rest the case on this one, and we have about 20 more minutes left. We want to stretch the session all the way until 11 p.m. tonight. Let's just talk a bit about Malaysian economy, in particular chicken prices and cooking oil. Okay, I think this will be another interesting topic to prod your brain a bit, Mr. Sani. So, chicken prices. Let's start with that. Why is it so high right now? And why is Malaysia running so low on chickens?
You tell me.
I mean, from what I researched so far, it's not because there's a disease in chicken or whatsoever. It's because producers are leaving and the demand is way higher than the current supply, right? It's just simple economics. But go ahead, Mr. Sani.
No, I think many countries, again, I'm going to talk in a very general sense. I'm not very familiar with why actually chicken prices itself, the supply and demand situation in Malaysia. But what I can tell you is, since I'm based in Singapore, what I can tell you is how the government here, what they've done. Okay, and I think when we have things to learn from other people, we learn from other people. Singapore, being a small little country, has always put food security as a very high priority in its overall security country's security measures lah. So it has always had some supply lines. What it realized during COVID was basically it doesn't work when there are multiple countries which shut down. Therefore you don't get where you turn to. Also your suppliers are not there. So COVID actually taught the Singapore government that actually they have to be self-sufficient. And so now we have situations where, and water has always been something, not only now, but now it's in terms of food. So Singapore is looking to grow its own food, whether it's in the labs or whether it's in every HDB public housing. The roofs are now being converted to grow vegetables and things like that. So they're taking it very seriously, and there are always measures and plans that are announced. We need to be sufficient by 30%, 40% by a certain time. So one thing good about here is they have long-term plans and they stick to it. Okay, and they measure it, and there's accountability and such. And just going back to the chicken one, what I do know is basically Singapore got cut off, of course, from Malaysian exports and therefore imports over this side. But they were very quick. They were very quick to open up new supply lines. They got basically chicken supplies from Brazil, Thailand, and most recently Indonesia. And I think that has helped to cover, so we don't even feel the absence of Malaysian chicken in Singapore, because we've got supply. Of course, nothing beats having fresh chicken, but again, it's frozen chicken, and sometimes you just have to deal with it. But there's still
chicken. It's
the
vital.
a chicken is a chicken.
Yeah.
So anyway, but it also goes to show that, for example, when the supply chain reopens with Malaysia, I think Malaysian exporters are going to get decimated. Because why? Because I think Singapore now, once they've opened up new supply lines with Thailand and Indonesia, can simply say we don't need you anymore. Okay. Yeah. So that's one thing also that's probably going to happen. But again, I'm also trying to say that Malaysia may have been a little bit behind the curve, so to say, because I think Malaysia has always thought it's sufficient. It has a lot of land and such. But remember, a lot of land has been converted for palm oil and so on. So there really needs to be, whether it's the National Disaster Agency, NADMA, or whoever, there really needs to be a long-term plan in order to make the country self-sufficient and secure in terms of food. And this is serious, because if you believe in climate change like I do, you know that basically the world's getting hotter and such, and you will face a shortage of supply. Do you know that basically crop yields decline by, I think, roughly 10% for every increase in 1 Celsius increase in temperature? So fast forward to 30, 40 years down the road, we are talking about a world which potentially has lesser crop yield by 20-30% of what we have today, because the world is just hotter. And if you are not prepared, you are basically going to find yourself in a very difficult position, because these are not things that you can do in a 1-2 year time frame. These are things that you must plan over multi-decades in order for it to be successful. So you need to plan now, and that's just what I'm afraid. I think people in the government in Malaysia needs to put a little bit more effort in this. I just want to again highlight something that the Singapore government has done with respect to climate change. Is issued a report to say which are the vulnerability across the nation here, countries, where sea walls need to be built, where more underground facilities need to be built, because it may be just too hot next time to have things above ground. Where so on, where the painting and such, the color, even to the color itself, the reflective capabilities of these paints or metals and such, everything is geared towards trying to make the island cooler, even if it's a little bit, because the fact of the matter is going to get hotter. So these are things which I think Malaysia needs to learn from. Again, we always learn from people. If it's a good thing, we take it and we learn and we say thank you very much. So we don't have to, so I hope that someone or the government in Malaysia is taking note of this, and I would ask most of you who try and Google, like, sea level, rising sea level models. I've done this before, and there are some websites out there which will enable you to simulate a rise in sea levels. So you can actually say, okay, sea levels in 2030, 2040, 2050, and it gives you a whole global overview of how things would change. You can see how half of Florida is underwater, and how parts of Klang is underwater, parts of Malacca is underwater. So these are just models. I'm not trying to scare anybody, but I think people need to just pay attention to these things, and because we can't do it at the last minute.
Yeah, good one, Mr. Sani. You touched the point on global warming right there, and I think that's the biggest elephant in the room, which is why, across the board, prices are gradually rising. But let's address the, I would say, smaller elephant in the room right here, because chicken prices just surged, and in Singapore, I don't think. Obviously, chicken prices in Singapore have been more expensive, but I don't think it's surged as much as Malaysia. Here, my kai fan seller, at my area, what he do is that he don't dare to raise prices. So last time he give you one big piece of thigh or something like that. Now he chopped into a few pieces for you and cut costs basically. And across the board, you really see everything just going up in prices, especially chicken. We'll talk about cooking oil later. And I think the biggest reason right here is because the government has been introducing price ceilings. Right? And if you're familiar with price ceilings, I'm sure you are, Mr. Sani. It's really counterintuitive to in the long run. It destroys the economy in the long run, which causes shortages, because right now the chicken is no longer at the equilibrium point of the supply and demand curve. So we'll touch a bit more on that one later, but right now we have a speaker over here. Haikal, you got anything to add on?
Yep. Actually, when Mr. Sani addressed about chicken, one specific point that I wish to add is, if you look at DOSM statistics, right, you will find that Malaysia actually produces enough chicken for consumption. But then you start to wonder, if that's the case, why are we seeing higher chicken prices? Betul tak? That's the thing. That's the funny thing about DOSM statistics. But if you dig deeper, you realize that we actually import everything relating to chicken feed. So everything that is required to raise the chicken itself is imported. So when you see dollar strengthening, and when you see the prices of chicken feed and everything going up, so commodity prices have been going up since for the past few months, or even past few years. So you kind of stuck there, because even though we raise our own chickens, but the cost of raising chicken has gone up. So it translates to higher price of chicken, which makes us think, if we want to really focus on our food security, which is a big concern, we shouldn't just focus on raising chickens. We should also look at every aspect of production, starting from raising it until selling it. So that's the thing that we need to look at . And about palm oil, I also have a few interesting insights that I might want to share later because you said later kan. So that's all.
Since you're on the line, do it.
Do it.
Excellent information.
This is golden.
Yeah.
And okay so for palm oil, so because of my position, I get to engage with those who are doing the dirty work itself . So two things that they always say. First, also price of fertilizers, again, which goes back to my earlier point on chicken price. So if we really want to focus on our food security, we need to make sure that everything on our supply line is secured. Now that you see fertilizer prices are going up, and then you have everything mess up, botch up supply chains, Ukraine war, and then you have all this crazy stuff going on, and it actually impacts our fertilizer price. And another thing that this is Malaysian specific lah is cost of labor, because we have labor shortages. They like cheap labor. That's an open secret lah. No, everyone knows that. So those are two things that are actually pushing up the price of palm oil. And remember, in March 2022, I remember that the price of palm oil was like 8,000 per ton. Now, thankfully, it has gone down to like 4,000, 3,000 something lah. I'm not a FCPO trader, so I don't follow daily prices, but it's around there lah. Why do you wonder? It's because Indonesia did something similar to what we are doing with our chicken. What Indonesia did was that they cut their exports for palm oil, and they finally realized that what they are doing is counterintuitive, like you mentioned. So they opened up back, and now supply has finally flooded back the market lah. But whether that translates to the decrease in cooking oil in Malaysia is a totally different story. That one is, we go back to what Mr. Sani said very much earlier in the session. It's like, okay, your oil price is 100 this year. Next year is still 100. Why? Because producers don't want to lose their margin now that they have their cost at 3,000 and they are for example, their cost is at 300 and they're at 30 and they're selling at 100. Huge margins. So are they going to reduce prices? We don't know. Probably not. That's the usual case we see here. But for the raw palm oil itself, the price has been going down since Indonesia opened up their exports back. But whether that translates to cooking oil price going down, that's a different story altogether. So those are some of my comments lah on these two prices.
Thank you. No, I think excellent. And I think if people take this crisis and, like Haikal has mentioned, understand the underlying problems and that there is a need to now go down the supply chain and make sure that we control the whole supply chain, things then, and if they change, then this is a blessing. I mean, an event can either be a curse or a blessing. If so if we take that as a blessing, then we should learn from it. I mean, as an economist, many economists will tell you we've moved away from globalization now. Years and years of globalization where everybody specializes in what they do, so because they get the lowest cost and such, so we fertilizers we'll get it from Ukraine or wherever where it was lower cost. We would sub out offshore our some of our manufacturing stuff. People are realizing that doesn't work anymore, especially in a very in a new environment where things are now going to be polarized. Everybody's going to go back to regionalization or blocks and stuff like that, and they're re-onshoring some of the critical stuff. Everybody now, for example, is vying for vaccine manufacturers to have at least one vaccine manufacturer in their countries, because hey, if this is going to be an occasional thing, I don't want to be caught in a situation where I have to go and bid for vaccines or end up with no vaccines for my population, even things like that. So I really hope policymakers understand from this crisis that these are things that need to change. These are things that need to be implemented, and so that we become, I always say, systems, and I've mentioned this before, you can have systems which bend and break. You can have systems which you hit it and it rebounds back. It's a robust system. And you can have systems which, like Nassim Taleb has mentioned, these are called anti-fragility systems. Systems where you hit it, it not only rebounds back, but it learns from it and becomes stronger. So if the Malaysian policymakers can take this, they're being hit left, right, and center now because of whatever the case is, but come back not only in a robust manner, but having learned from it, then I think we have a bright future. Except that basically, I think confidence in our policymakers are maybe not that great. Not say policymakers, sorry, but more politicians. And I have to say, when I say policymakers, I know I came from I studied in Malaysia. I came from MRSM Kuantan. I have friends who are high up in the policy making departments and such, and they are bright people probably like Haikal and such, and they are people who if they go into any place, like for example into Singapore civil service, and so I think they will do well. What I'm trying to say is, I think we have the people. The thing that we may need to or the thing that's impeding us sometimes, it's the politicians, sad to say, but I don't want to bring that up because again we are talking about economics.
Yeah. When it comes to politics, it becomes a very sensitive and shady topic to talk about. But Haikal, if you ever want to go to apply to be a politician, let us know. We'll vote for you.
No, that's what if you look at Jokowi, what he has done, he's brought in a lot of new young people.
Yeah. We need the young blood, basically, and young minds that really have a different perspective. Not to say that, but the perspective is necessarily better, but it's just different, and you get to see things at different angles. But let's stay on topic right here, in particular chicken prices. I do want to spend a bit more time right here. We're reaching 11 o'clock already. This is probably spend about 5-10 more minutes. What is the solution here? Just now we talked about controlling the supply line and stuff like that. But the government's solution to this quote-unquote problem is to just put a price ceiling. And Mr. Sani, I think we want to discuss more about the price ceilings, because at the end of the day, it just causes more shortages and exacerbates the problem even further. But what is the solution here, man? Do price ceilings work?
I mean, long story short, temporarily yes, long term no. I mean, there's a distortion between supply and demand when you put a price ceiling. Someone has to pay for the fact that you're not allowing so-called market clearing prices. So it's either the supplier pays a price, or the consumer pays a price. And if the ceiling is placed in such a level where the consumer benefits, then of course the supplier pays the price. And when the supplier pays the price, the big question is, will you stay around? If this thing is long term, are you going to make enough to incentivize you to continue in the business itself? So these are things where there's a distortion unless the government subsidizes the suppliers and allows him to make back whatever he has lost. Then we have something called a dead weight, and it's just at the end of the day not something which can be sustained. This is really a nutshell kind of answer.
Yeah, that was a very well-rounded answer. I don't think I could have worded the answer better, because it's actually quite a complex topic to talk about when it comes to price ceiling, because you have to understand supply and demand, equilibrium point, blah, 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 but we're not going to go through those. So what's the solution here? Okay, let's say, we know price ceilings do not work. And because the next thing that we have to look at is cooking oil. At the end of the day, the government is going to put a price ceiling on cooking oil, and the entire problem repeats again, right? You talked about sellers leaving the market, producers don't produce anymore because it's no longer profitable unless the government subsidizes them. But even after the subsidies, you know that the government won't subsidize them enough that will make the business profitable. So what's the solution here? Should the government just not do anything and allow the free market to determine the prices of chicken, or what?
I wish I had an answer to that.
Yeah, it's difficult, right? This question is
it's difficult when you make decisions in a crisis, because in a crisis people are suffering.
Yeah.
And you make decisions, that means it's going to be very difficult. These kind of decisions, in my view, have to be made and have to be planned for outside of crisis. In a very stable environment, you make scenarios. You ask yourself, if this happened, am I prepared for it? I mean, like for example, if I'm sitting in as a policy maker today, I'm going to instruct Bank Negara and say, what happens if the ringgit goes to 5? Can Haikal, can you tell me how many of our corporates will actually come under stress? What happens if interest rates need to go up because inflation is run away now? If our OPR goes up to 6-7%, and this is not very high because it maybe it was the case 10 years ago, but let's assume what happens if we need to spend 6% of our fiscal deficit, because what is that going to be a hit on our rating? So I think we need to do these kind of scenario building, because we cannot wait until we're in that situation and like, oh no, what's now? Okay, Haikal, please go and find out. We're ringgit's at 5 now. Can we see what's going on? Which is very much the case that I've seen most of the time. So I'm sorry to answer your question. It's difficult because if I were to say now, we ought to have dismantled. We ought to have planned earlier. And now, if we do it now, it's just going to hurt a lot of innocent people. So it's very hard to answer now.
Yeah. I mean to put it at a very simple perspective on what you're trying to say, for those younger generation out there like me, is to be like Thanos, have the time stone, rewind time, and prevent the problem from happening in the first place. Yeah. So, Haikal, I just want to prod your brain a bit about this chicken prices over here. What would you do in the current situation? Will you still constrict market prices, or I don't know what's the solution here, but is there anything?
Makan ikan.
Yeah, Haikal.
Makan ikan.
Yeah.
Personally, I'm a fan of free markets. I will admit, even in work, when I am for free markets, I try to reduce regulations as much as I can. So if you ask me, I will leave it to free markets. But at the same time, because we are in a crisis, and remember, we are in a democracy. I'm not saying that democracy is bad, but we are in a democracy. Every policy you make has a political consequences. So when you are a policy maker and you answer to politicians, right? So you need to try to find a balance between the two. So in one way, I would argue for free markets. I will not go for price cap or price ceilings. But at the same time, temporarily, what I will do is I will do like Singapore. I will try to source more chicken elsewhere. That's the temporary solution. And of course, the long-term solution is what I've mentioned earlier, to secure our supply lines so that we are not as impacted in the future.
Yeah, we need to elect this guy. Any way to get him inside the cabinet right now and talk to the finance minister or something like that, because I don't think they're doing their jobs right. Here we have a guy who casually coming into Twitter space proposing the solution to probably the entire nation's problem, right? Chicken prices rising and stuff like that.
But I think Haikal has hit the nail on the head, meaning to say that we have very bright people in policy making. It's just that when the political aspect comes in, it just gets, I don't know, diluted, put aside under other considerations and such. So that's the thing. I mean, technocrat, bureaucrat versus bureaucrat, that kind of situation.
Yeah. All right. I think we have finally have to come to a close to our session tonight. It's been a wonderful one. Thank you so much, Haikal, for joining us tonight. Really, I hope you go out and apply to be a politician now, because we are very eager to elect you right now.
But I want to thank you because I've been following your sessions, and your sessions are very insightful naturally. So thank you for you and Mr. Sani as well. I enjoy following both of you.
Hey, thank you so much, Haikal. Thank you. We will learn from each other. At the end of the day, I'll go right here. So, Mr. Sani, as usual, great things we shared tonight.
Glad to share.
Yeah. Thank you so much, guys. Stay safe out there. The cases are rising right now, COVID, and maybe you might even consider to get another booster shot. They're really talking about it. But yeah, guys, I'll see you guys soon.
Okay. Right. Thank you.
Bye.
Bye.